Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Union Pacific, ticker symbol UNP. Union Pacific Corporation, or UNP, is one of the largest freight railroad networks in the United States. Operating a 32,000-mile network across the western U.S., it plays a crucial role in transporting goods, particularly for industries like agriculture, energy, and industrial products. The company benefits from its leadership in the railroad industry, with a focus on sustainability through improved fuel efficiency and energy-efficient technologies. Union Pacific has shown strong financial performance, with consistent revenue growth and a solid dividend history. While its performance is sensitive to economic cycles, the company has growth potential in infrastructure spending, intermodal services, and technology integration. However, it faces challenges like labor disputes, fuel cost fluctuations, and environmental concerns. The reason I think Union Pacific is an interesting opportunity is because the railroad companies have a lot of very unique things that kind of set them apart. So when you think of railroad companies, you think of companies kind of stuck in the past. You don't think that it would ever be lucrative to own a railroad. But I think that there's a really good argument to be made that these types of companies are some of the greatest stores of value simply because they're inflationary proof, because it costs a lot of money to get started, but once you get all that infrastructure down, I mean, you're basically paying what you paid back when you put it in. You're not having to maintain it for an insane amount of costs. Obviously, there is maintenance costs and things like that. But once you have everything running, I mean, there really isn't a lot of inflationary factors affecting this stock, right? Also, there's not a lot of new competition coming. So, I mean, your revenue is pretty safe. There are a few competitors, but people are still going to be using the railroads into the future, and a lot of things aren't really changing. Now, the disadvantage when doing a DCF model valuation or any kind of valuation of the stock is that a lot of people are also thinking the same way, and usually these stocks are very close to their fair value, but there are kind of anomalous situations. Like when I did my video on Prologis, which is a different type of company, but they are a warehouse sort of real estate investment trust, right? So very simple to understand company, and I saw that it was undervalued according to my calculations, so I bought in and I made some money. And that's kind of what I'm hoping to do with Union Pacific, because if you can get in for the right price and collect a dividend forever, I mean, that's not a bad arrangement when you're owning a stock that you're up a lot on, and you're just getting paid to hold it forever. And it's not going to fluctuate crazily. I mean, you're not going to get these weird swings. Sometimes you're going to have a bad earnings call. Sometimes you're going to have a good earnings call. But these stocks are relatively stable unless they're over or undervalued, right? So if we can find the correct value, I think that we can make a lot of alpha if this thing is undervalued. The stock currently trades for $247.79. It's about flat over the past year, down about 0.22%. There are some fluctuations month to month, as you can see in the yearly graph here. The market cap currently sits at $150.22 billion. The price to earnings ratio currently sits at 22.35, and the annual dividend yield is 2.16%. The 52-week low of the stock is $218.55, and the 52-week high is $258.66. So there is some price fluctuation from the 52-week low to the 52-week high. I'm guessing that could be fuel costs, and that's a big factor in this stock, right? If fuel is cheap, this stock is doing very well because everything's pretty constant. It's a mature company. There obviously isn't new railroad lines to be built, but they're always looking at ways to optimize with a company like this. So it's interesting that we got so much fluctuation, and maybe that was due to, the recent presidential election. It could be due to a number of factors, but as it sits now, the market cap is $150.22 billion. Analysts are more bullish, but very split on Union Pacific Corp, with 4 rating it a strong buy, 12 rating it a buy, 13 rating it a hold, and 1 actually rating it a sell. The price targets range from anywhere between $220 to $290, with the average being $263.79. The stock is currently trading for $247.79. So this tells me that the stock is probably near fair value, since there's like a 50-50 split on what the future value should be. But there are a lot of just macroeconomic factors that are weighing on the stock. So oil prices are obviously, like I said, a really big one. And just overall efficiencies and regulations could also be a really big thing that could affect this stock. But analysts are virtually split down the middle. None of them are really saying sell other than one, but 13 rating it a hold. That pretty much means you should not be buying right now. But if you're obviously, it just means hold. Like, if you have the stock, hold it. Don't sell it quite yet. But one of them does think you should sell because they think that the stock is overvalued. But you also have the 16 analysts that rate it as a buy or a strong buy. So there's kind of just this 50-50 split on whether it's at or above fair value or if it's undervalued. Here's the weighted average cost of capital for Union Pacific. I got 6.35%. This is with a cost of debt of about 2.876% and a cost of equity of 7.146%. As you can see, the total debt weighting is 18.53%, and the equity weighting, which is the market cap, is 81.47%. With the free cash flows, I think it's pretty interesting. This is where break even would be. And so this is with a 13% growth of the free cash flow over the next 9 years. I don't think this is reasonable. I think it's closer to 10%, which would be a downside of about 22.22%. I also modeled this after the average free cash flow. I didn't actually decide to use the trailing 12-month number. Obviously, you can go a little bit higher because these past free cash flows were not as big, but the 2023 number is actually the smallest. So I actually think this is a pretty good metric to be using to model this company, especially because the free cash flows aren't really going to change very much. I think that this stock, I would avoid it at this price. I think it's run up too much to justify where it's at. I understand that it's the biggest in this industry and it has those advantages. I also understand that the new administration is probably going to be more favorable for Union Pacific, but I don't like the opportunity cost here. I think that's the thing really keeping me away from Union Pacific. I think there's a lot more companies that are reliable and safe that I would rather put my money into, like a Waste Management, and a number of other companies that I think are just stronger. Prologis, I think, is better for the price that it's at now. I think that you could even make a case for Energy Transfer right now with the AI demand. These are just companies in my own personal portfolio that I own, and I would rather be buying more of them than be investing into Union Pacific personally. But if we get a 15% growth rate, there's obviously huge upside. But I think that's totally unreasonable, right? For a company like Union Pacific, I think that you're only going to get small growth, and I think that you should be very scrutinous about it. And I think that there's significant downside to this stock currently. I don't think that the stock is going to increase. Now, if there are updated earnings and they do better, then this stock will probably be a different valuation. But as it stands now, I don't think that this stock is high enough quality to be putting money into. I think it's very safe, though. I think if you wanted to act like Union Pacific was your bank account, you could buy it when it dips again and it's closer to its fair value. Even buying this at fair value isn't necessarily a bad move because your money's going to stay pretty consistent over time. There's not a lot of ambiguity or risk necessarily with the stock. There's not a lot of risk that someone's going to build something to displace the railroads. And, you also might get some synergies that the whole market's going to get from AI. I think it's going to make this stock a little bit more efficient, with how it uses materials, and that's kind of the thing that it's banking on the most. So there could be future growth down the pipeline that I'm just not seeing on the balance sheet right now. But I doubt that they're spending a significant amount of their money to lay down new railroad tracks or do things like that. I think that this stock is overvalued currently, and that's my analysis on it. So if you like the video, please hit the subscribe button.